The housing market story of the last 3 years has been interest rates, of course. As mortgage rates rose, homebuyer demand slowed. As demand slows, inventory grows. Home sales remain super slow. In 2025, mortgage rates have stayed stubbornly high for yet another spring buying season. Potential home buyers have responded by not buying homes. We base our 2025 housing market expectations on assumptions that if mortgage rates finally shift lower, that will spur demand and the number of home sales will increase. Likewise, if mortgage rates jump again, potential home buyers will feel that and will continue to sit on the sidelines. But suddenly there are new variables to consider. The macroeconomic story is shifting. So, new trade policies, immigration policies, reduced spending are all degrowth and have recession talk back on the table. Unemployment is starting to inch higher. We haven't had unemployment in this country for many years. So, the question is, how will the housing market change as these economic assumptions change for the first time in a long time? And really, how quickly can we measure the changes in the housing market supply and demand as these new conditions take over? So, for example, the weekly new listings count is starting to rise above the extremely tight levels of the past 3 years. So we have more sellers this year. I'll share this data in a minute. But are those sellers the first people feeling the new pinch? I should be clear, the data is not all bearish. The weekly pending home sales rate is nudging higher along with these new listings. We're only 2 months into the new government policy. So the US economy was strong as we entered the new year. So it has still lots going for it. These are early shifts in the vibes only. If you follow my work, you'll know that we've been on recession watch for the housing market for most of the last 3 years. It's not new for us to be on recession watch. I'm probably over focused on it. And the economy has kept growing during all that time. So we'll see if the current fears actually materialize. They may not. But here's the thing, we've been assuming that lower rates in 2025 would increase demand faster than supply. This has been a safe assumption for the last 15 years because at that time, the economy was growing and unemployment was low. As a result, interest rates were the important lever. Now, if homeowners are sensing the first economic downturn in a long time, do those changes impact supply faster than falling rates spur demand? So that's the shift we're watching for. I'll show you what I mean when we look at the data below. By the way, the HousingWire Altos monthly webinar is this Thursday at 10 a.m. Pacific. In the webinar, we get to take an hour to dive into all the signals. None of the signals are strong for housing this spring, and despite crazy new economic variables, we're still maintaining our assumption that home sales will grow slightly in 2025 over 2024. So we'll have time to show all that data and tons on the local markets. Is the DC metro market changing? Will Florida recover this year? So much to track. Anyway, that's this Thursday, March 20 at 10 a.m. Pacific. There's a link in the description below to reserve your spot. So click that and join us Thursday. Okay, now on to the data for this week's housing market. Let's start with the new listings data today. So this week saw 68,000 newly listed single family homes. The pace of new listings seems to be picking up finally. So for the spring and for the post-pandemic era. There were nearly 7% more sellers this week than the week prior, and 14% more new listings unsold than last year at this time. So, in fact, there were more new listings unsold this week than in any mid March since 2020, just before the pandemic hit. So, the bottom line is that this spring, more sellers are trying to sell their homes. See, the purple line here is steadily growing and separating from last year's blue line. That's the seller volume steadily approaching the old normal levels of new listings each week. The gray lines are prior years. There were 68,000 new listings this week. Last year, it was only 59,000. Now, in 19, there were 74,000. So it's not a lot of sellers, but we are breaking from the post pandemic shortage. So, what is driving the seller behavior? Is it economic vibes? Is it pent up shadow inventory for people who've delayed moving for 3 years? Keep in mind that since seller volume has been very low for nearly 5 years, essentially every homeowner in the country has an ultra cheap mortgage, which no one wants to get rid of. But now, 3 years after mortgage rates have started climbing, there are a few million homeowners who do not have ultra cheap financing. So those owners are more likely to sell. If it's more expensive to hold, we are more likely to opt to sell. So over time, as rates stay high, we slowly emerge from the mortgage rate lock in. That means more sellers just with time. On the other hand, we also have the vibe shift. So the DC metro economy seems likely to be on the downswing. New listings rate is climbing in DC. It's not super high, but maybe that shift is underway. The DC metro market alone is not enough to move the needle for new listings nationally. There are only 674 single family homes newly listed this week in the entire DC metro region. That's up from 601 the week prior. So it's growing, but it's a tiny fraction of the US. The reason we pay attention is that it is potentially an example of what could happen in a macroeconomic shift in the country. So that's why I ask if these are maybe what the first of what we might call bad economy sellers. You know, besides a few weeks at the very start of the pandemic, we essentially haven't had a bad economy with unemployment in like a decade and a half. So we see the shifts very quickly in the new listings data. So stay tuned. Available inventory of unsold homes also had a pretty big increase this week, climbing 2% to 656,000. While this time of year, it's totally normal for inventory to build each week. That's slightly faster build up than we expected. The inventory increase is from the new listings, as I mentioned, and demand is still pretty light. So it came to 13,000 more single family homes on the market now than a week ago. Last year, there were only 5 weeks in April, May, and July that had inventory gains more than that in a given week. So this week's inventory increase is pretty notable. In this chart I have here, each line is a year's inventory curve. The purple line for 2025 ticked up this week. Inventory grew faster this week than the same week a year ago. So there are now 29% more homes unsold on the market than last year at this time. That is, inventory has been roughly 28 to 30% greater than the year prior for like 6 months. So we've been assuming that inventory will keep growing, of course, but at maybe at a slower pace than 2024. We expect that by the end of the year there will be maybe 18 or 19% more homes on the market, down from 29% now. If the assumptions in our models hold, that means in the next couple of months we should see that gap shrinking. The gap grew this week, though. So if the gap continues to grow, that'll be new signal for the rest of the year. That's what I'm watching for with inventory. We know that inventory will continue to grow, but will the gap between 2025 and 24 continue to expand, or will it shrink as we've previously expected? So in this chart, watch if the purple line continues to separate above the blue line as we roll into the second quarter. So that's the supply side of the equation. Supply is increasing. So it's critical to know if sales are keeping up on the demand side. The good news is that the weekly count of pending home sales is climbing for the spring. There were 66,000 single family homes which took offers and started contracts this week. That's up a nice 4% for the week. Home sales are finally just about exactly where they were last year at this time. The purple line in this chart has been running about 3% fewer sales than in 2024, but the sales momentum might be shifting. Last year, the second quarter, mortgage rates were on their way to their most expensive for the year. So sales were slowing relatively at that time. So now maybe we have the momentum in the other direction. So mortgage rates are 50 basis points cheaper than they were earlier in the year. And so I'm going to predict that next week's data shows the weekly pending home sales that is slightly above the same week a year ago. So I'm just assuming that this would happen because basically Q1 and Q2 2024 were really slow. So the comparison gets easier over the next quarter. So stay tuned if my guess for next week is right. There are significantly fewer immediate sales happening now. These are the potential home buyers know they can wait for the right deal or better financing. So even if sales pick up, the time on market is generally longer, and buyers are waiting for shifts to jump in, for example, when the timing is right. Most of our home price measures ticked up this week, as you'd expect for the spring buying season. The median price for this week's pending home sales came in just under $390,000. That's basically unchanged from last week, up a smidge. And in fact, it is basically the same median price as last year at this time. So in this chart, we have the median price of the weekly newly pending home sales, $390,000. The purple line is for this year. It's slowly inching up for the spring. The blue line is last year. So I expect a slight bump in next week's sales prices. So the trend stays slightly elevated over last year. The pattern has homes about 2% more expensive than they were selling in 2024. Just 2%, barely positive. As supply grows and as mortgage rates stay mostly elevated, I don't see any catalysts for home prices to grow any more than that. In fact, I've mentioned that I'm on the lookout for negative pricing pressures. Those signals of home price declines are not in there, but prices are basically flat from 2024. Meanwhile, the median price of the active listings is $439,000 now. That's up almost 1% for the week with spring, of course, and is also just about 1% greater than last year at this time. Uh, by almost every measure, home prices are essentially unchanged for the year, just slightly higher. The active market is up 1%. The weekly pendings are unchanged from last year. So the thing to watch for in home prices is whether any of these signals turn negative with increased supply. So if mortgage rates were to jump, I would expect prices to correct down. I started today talking about new economic vibes. So it's far too early to see those vibes in sales prices, but we are watching first for the impact of the vibe shift in the supply numbers. And then after the supply numbers, prices come later. And let's wrap today with the leading indicator of future home sales prices, the price cuts. So this is the percent of homes on the market with price reductions from their original list price. And it moved up this week to 34%. So 34% of the homes on the market have taken a price cut from the original list price. So that's a pretty substantial number for mid-March. That tells us that there is no turnaround in demand, which I suppose is obvious. It implies that future sales prices will continue to have no upward pressure. So in this chart, you can see how the 2025 pricing pressures are elevated over March of any recent year, the purple line for 2025. You can also see the fall of 2022 had the most price reductions, the most downward pressure. So the price cuts in November 2022 led to year over year home price declines in the spring of 2023. So this is a 4 to 6 month leading indicator of future sales prices. And so it's natural for price cuts to accelerate a little bit in the spring. Any home listed in March without offers in April will start to consider a price cut. So two things matter here: the absolute level of price cuts, which is high right now, and the speed at which listings are cutting their prices. So 2022 had both of those conditions. This year is slightly more subtle. So the key takeaway from the price reductions data is that there is no bullish signal for prices in the coming months. Okay, that's all the data we have time for today. This week, Thursday, March 20th, is our webinar. If you're not registered for that, these are limited to 1,000 attendees. So you have to register and reserve your spot. You can still book your spot now. There's a link in the description below. If you need to communicate about the housing market with potential buyers and sellers, you should join us at Altos Research. You can get a free account with your local data. Go to altosresearch.com, run a free report, and let's get started today. Thanks, everybody.